Okay, well, I think we're going to get started on the next part of our presentation. As I mentioned earlier, my name's Josh Goodman. I'm with Pew's State Economic Development Tax Incentive Project. And I think actually the presentation from results first. This is the first time we've done this in this way, but it's a great lead-in to our work because a lot of what we're working on are really cost-benefit analyses and program analysis focused specifically on economic development tax incentives. As you have been, feel free to jump in if you have any questions. Just raise your hand, or if anything I'm saying doesn't make sense, make sure to let me know. First of all, let me tell you a little bit about what I mean by economic development tax incentives. And I think probably everyone in this room is familiar with these kinds of programs. States have lots of different tax incentives to benefit specific industries, to create jobs, to incentivize investments, enterprise-owned programs, research and development tax credits, film tax credits. There are many different kinds of incentives. And the part of this definition I actually think is most important is the third part, by encouraging people or businesses to do something they otherwise would not have done. And so the whole point of an incentive is to increase the influence of the tax code on business decisions, to get them to do something they wouldn't otherwise have done. So why do we at Pew care about tax incentives, and why should you care about tax incentives? The real reason why is really there are two reasons. The stakes are high for states' budgets, and the stakes are also very high for states' economies. And so when states are engaging in economic development, when they're trying to encourage investments or job creation, the costliest tool they use and the most ambitious tool they use are economic development tax incentives, more so than grants or loans or other kinds of direct assistance to companies. States use tax incentives. And tax incentives cost billions of dollars a year, and those costs seem to have increased over time. One good example of that is film tax credits. Actually, since we have some Canadians in the room, they might be familiar with this. In the late 1990s, I believe it was, Canada started offering incentives for film, and a lot of American films moved to Canada. And what happened then is states started competing with Canada, started offering their own tax incentives. So today, whereas back in 2000, it was only a couple of states maybe that had film tax incentives. Today, most states have film tax incentives. They cost around $1 billion a year. And so states don't want to miss opportunities to create jobs and grow their economies, but they also don't want to be investing in programs that are ineffective, because a dollar used on tax incentives is a dollar you can't use on something else, so there are trade-offs involved. And so that's what really has motivated our research. And so far, we've put out 2 research reports on tax incentives. And the first one was Evidence Counts, which I think our team at Pew feels lucky that we got to that report title before someone else got to it, because at Pew, that could basically be the motto for the entire organization. But Evidence Counts was about evaluations of tax incentives, so things like cost-benefit analysis. And it asked, do state policymakers have the evidence they need to determine whether their tax incentives are delivering a strong return? And then the second, Avoiding Blank Checks, was about cost controls. And it asked, are policymakers effectively managing the fiscal risks of their tax incentives? And so what we did in these 2 reports is we identified ways that states could say yes to both of those questions. Yes, their tax incentives are delivering a strong return, and yes, we're managing the fiscal risk. So this year, along with continuing to do research, we expanded our work to working directly with states. And so far we've helped Rhode Island design and pass legislation that creates a schedule to evaluate tax incentives. And we've also been working with legislative staff in states like Nebraska and Maryland who are actually doing evaluations, so the more technical kind of assistance. And to be very clear, we don't take any position on whether tax incentives are good or bad, whether any particular type of tax incentive is good or bad, whether states should spend a lot of money or a little money on tax incentives. Our whole perspective is that states need to be able to answer those kinds of questions for themselves using evidence to see what works and what doesn't. And so the overall picture revealed by our research, and it really gets back to what Gary was saying earlier, is that states frequently rely on anecdotal information. They frequently rely on incomplete information when they're making decisions on tax incentives. So I guess little Timmy grew up, now he owns a business, and there's an anecdote about how great his company is, but states need evidence about what works and what doesn't. So in our research, we identified 3 steps states can take, 3 sort of overarching steps. The first, states need to plan carefully before they approve and expand incentives to avoid blank checks. Secondly, states need to thoroughly evaluate the results of their tax incentives. And then third, they need to connect those evaluations to the policy process. So it isn't enough just to have great evidence that no one's looking at and no one's using. States need to put in place tools so that those evaluations inform policy decisions. No state has mastered all of these steps yet, but many states have done promising approaches in one or more of these areas. And so a lot of my presentation is going to focus on examples from states that have done this well. And you know, we really think there's examples for other states to learn from in what states are already doing. So I'll just start with avoiding blank checks. And when we wrote the report Avoiding Blank Checks, what motivated it was really that we saw all these examples of states where tax incentives were costing far more than the state had expected, where the costs were growing very quickly, and that it was causing problems for states' budgets. Since we have some people from New Mexico in the room, I'll use New Mexico as an example. And New Mexico's high-wage jobs tax credit in a couple of years went from costing around $6 million to costing around $45 million, I believe. And, you know, that might have been all right if it meant that businesses were creating tons and tons of high-wage jobs in New Mexico, and so there was more interest in this incentive because there was all this great economic activity. But that wasn't really what was going on. Instead, the way this incentive was designed is that it didn't have to be a new job for you to claim it for the incentive. You could actually go back to when the program was created in 2004 and claim jobs that had been created ever since then for the incentive. And so what happened is that businesses had finally started to realize that, or their accountants had finally started to realize that. And so businesses were claiming incentives for jobs they had created years ago before they even knew this incentive existed. And there were a variety of other things going on. But we've seen that with all kinds of different programs. Renewable energy incentives in Oregon, high-tech incentives in Hawaii, drilling incentives, horizontal drilling incentives in both Oklahoma and Louisiana. So it's really a problem in a lot of states. And if you want to know what that problem looks like, it looks like that giant pile of cash. And the problem in these cases isn't that incentives are expensive. It's that the costs are unexpected, and they aren't what policymakers necessarily intended. So this is incentives have led states to have mid-year budget shortfalls or budget gaps when they're writing a budget for a new year. And so even if they decide that this higher level of incentive is appropriate, it causes problems for planning and writing a budget and implementing a budget. So what can states do about this? There are two steps that we found states can take to avoid blank checks. The first is up front to have a reliable estimate of the incentive's fiscal costs. So what's known as a fiscal note in many states on the legislation creating or expanding the incentive. And then secondly, to have annual limits or caps on the cost of incentives. And we found lots of states using these tools, but we've also found states using them inconsistently. So I'll start with fiscal notes. And fiscal notes, we really think serve a very common sense purpose. Before legislators vote on a bill, they should know how much it's going to cost, or at least have an estimate of how much it's going to cost. But for a lot of tax incentive bills, we found legislation that had no fiscal note at all. We also found cases where there was something called a fiscal note that did some analysis, but that didn't give any estimate of how much the legislation would actually cost. And so in addition to just merely existing, the other thing we look for fiscal notes on tax incentive bills is some kind of estimate of how popular the incentive will be. And that's often the really difficult question. How many companies will take advantage of this incentive? How much will it cost? And to give you an example, North Carolina in 2010 was expanding its film tax credit. And what the legislative analysts did when they were writing the fiscal note is they worked with the Department of Commerce to come up with an estimate of how many additional films this incentive would attract. And what they said is that it would bring in 2 more major films above and beyond what the existing incentive would have attracted just in the next year, and even more films after that. And so the expansion was going to raise the cost of the program, they estimated, by more than $50 million a year. And a lot of the reason they were able to come to that estimate is it wasn't, purely a static number. It was taking into account how attractive the incentive would be. Besides looking at individual examples of fiscal notes, another thing we were interested in was fiscal note policy. Were there policy states had put in place that made fiscal notes more useful for lawmakers and that sort of improved the whole process? And Minnesota was a place with a couple of examples of that. Minnesota does a couple of interesting things with fiscal notes, not just on tax incentives, but also on other kinds of legislation. One thing is that every bill that affects tax collections in Minnesota has to receive a fiscal note on its final version. What you see in a lot of states is there's a fiscal note at some point in the process, but then the bill is amended and there's no guarantee that even if there are substantial changes to the legislation, there'll be a new fiscal note. So in Minnesota, there's this requirement to have an estimate on the final version. And what Minnesota also does, which is even more unusual, is if the fiscal note shows that that legislation is going to throw the budget out of balance, there's a requirement that the state either cut spending elsewhere or raise revenue elsewhere to make up that difference. So in a lot of states, fiscal notes are purely advisory, but in Minnesota, they actually have this clear connection to the policymaking process. Now, fiscal notes are very important, but they don't offer complete protection to state budgets. They only look out a certain number of years into the future, and they don't, they're always based on estimates. And so that's where caps or annual limits really have an important role to play. And what caps do is provide a level of certainty that an incentive won't cost more than the state intended it to. And they also, though, provide flexibility to policymakers, which is a very important point, I think. So most states sort of use caps on an ad hoc basis. Some incentives have them, some incentives don't. But Iowa has taken a more comprehensive approach. And in Iowa, what they do is many of the major incentives administered by the state's economic development agency have an aggregate cap. A few years ago when this aggregate cap was created, the state set it at $185 million. But then in 2010, when the recession was battering the state's budget, they lowered it to $120 million. And then this year, after a robust debate, they raised it back up to $170 million. And so what I think the story of Iowa's aggregate cap shows is it makes budgeting for tax incentives more like budgeting for regular programs. So in the same way that you have an agency where you're giving it a certain amount of money every year, every 2 years, and have an expectation that it won't spend more than that, this makes tax incentives work the same way. Okay, so the second step is evaluating results. And this really gets into, the heart of our work and stuff that is, in many cases, described as cost-benefit analysis. And what I'm talking about here goes a step beyond just sort of reporting basic numbers. So a lot of states have the companies that participate in incentives report how many jobs they create. A lot of states have tax expenditure reports that have, say how much the incentives cost. And those are valuable measures, but what I'm talking about is more rigorously in analyzing the economic impact of tax incentives. And this is something, when we did evidence counts, we were gratified to see how many states were at least doing this sometimes for their incentives. States have had auditors, legislative staff, departments of revenue, departments of commerce, outside consultants they've hired, try to rigorously analyze the economic impact of tax incentives. So it's happening in a lot of different parts of state government. And I think it really helps to focus on some key questions to get at what I'm talking about. First of all, one of the critical questions is, to what extent did the incentive affect the choices businesses made? And as I said at the outset, an incentive is intended to get businesses to do something they otherwise would not have done. But what state officials have told us and what the academic research shows is that it's almost impossible to design an incentive that doesn't at least partially reward what would have happened anyway, as opposed to incentivizing new behavior. So what a really good evaluation does is it gets at that whole issue. And it's not easy, but states have found creative ways to do this. So to give one example, in Oregon, they were evaluating renewable energy incentives for things like wind farms and solar farms. And what they did is they used financial models from companies participating in that program. So for a wind farm to be economically viable, it needs to produce a certain amount of energy at a certain cost and sell it for a certain price. And so when you have that kind of model, what you can do is say, okay, is this incentive large enough that it's changing projects that wouldn't have happened because they weren't viable into ones that are now viable? And so that's how they got at this whole sort of but-for question. Secondly, how were existing businesses affected by the incentives? And so there was a great evaluation of this question in Louisiana. In Louisiana, businesses participating in the state's Enterprise Zone program reported creating 9,000 jobs in 2009. But what the evaluation from the state's Economic Development Agency said is that many of those jobs were in sectors where, that were limited by local demand. So to give you an example, grocery stores. If a new grocery store opens in a town, that doesn't mean more people are shopping for more groceries. And so new jobs at that store likely come at the expense of jobs at an existing grocery store. So taking into account that factor, they said that it was more like 3,000 jobs rather than 9,000 jobs that the program had created. And finally, did the benefits outweigh the negative effects of paying for it? And so this is where you really sort of get into the question of trade-offs. Any time states do anything with dollars, it has some economic effect. Even if you were to fly around with a helicopter throwing money out of it, no state has tried that to my knowledge, but even if you did that, then the people who picked up that money would go to the store and buy something, and that would have some economic effect. So the question is, what else could you have used this money with, and what are the costs? What were the economic implications of that? So to give you an example, Massachusetts, their film tax credit, they found that it had created 1,600 jobs in 2009, but it also came with a $70 million price tag. And so when you're sort of accounting for that price tag, you could say the state would have cut taxes with that money across the board, or you could say it would have cut spending. And so, I mean, it would have increased spending if it had those $70 million. And so when they did the estimate based on increasing spending and said, well, that would have created 1,400 jobs. So the net number was 1,600 minus 1,400, so around 200 jobs. Besides doing this kind of economic analysis, another part of really important part of a good evaluation is drawing conclusions And so not just stopping with a bunch of numbers that don't really mean anything to anyone, but drawing conclusions about whether the program is working, and also, very importantly, how it can be made better. And this is really, we found lots of evaluations that didn't take this step. And one of the most common reasons why is that incentives often don't have clear goals associated with them. And so it's really hard to say whether a program is working if you don't know what it was supposed to do in the first place. So in a perfect world, legislators would always, put clear goals in the law when they create them. But states have also had success after the fact to consider, reconsider, okay, why did we create these programs? One good example of that was in North Carolina, where legislative staff, the evaluators, and the legislature all worked together to set goals for programs, and that really resulted in an evaluation that came with clear conclusions and recommendations. And what we recommend is that states conduct these kinds of evaluations for all their major incentives. And one of the key reasons to do that is because then you can compare programs against each other. So the same kind of chart that Gary was showing for interventions to reduce recidivism, it'd be great if more states had that kind of information for economic development programs to be able to compare programs against each other. When we published evidence counts, there were 16 states that had taken major steps to evaluating all their incentives, and there were 9 states that had scheduled recurring evaluations, so it wasn't just a one-time thing, and that was these 9 states. And since evidence counts came out in 2011, we've been gratified to see that more states like Florida, Maryland, and Rhode Island have moved in this direction as well. Any questions on evaluations before I move on to our last step? Okay. So the last step is informing policy choices. And this is something that's really important for tax incentives. The way a lot of tax incentives work is that they exist as permanent parts of the tax code. So they can continue indefinitely, in theory forever, without anyone necessarily having to revisit them. And even when there's an evaluation that does a good job looking at the programs, there's often no impetus to actually sort of use that evidence and connect it to the policymaking process. And the state that's gone furthest in fighting this tendency is Oregon. And Oregon's done a few notable things. The first thing they did is in 2009, they put 6-year sunset dates on almost all of their tax credits. And so then if tax credits are going to expire, it sort of forces a choice by the legislature. They either have to act to continue them as is, or they can revise them. And so in 2011, they had the first set of sunsetting tax credits. And what they did is they created a brand new Joint Committee on Tax Credits, which solicited evaluations from the agencies that administer the programs. It held hearings. It took testimony. It did all the things you would expect a state's budget process to do, but it was doing it for tax incentives, which is very unusual. And in Oregon, this was a big success. The state allowed some programs to expire, but also continued some for another 6 years and revised others, including reforming one incentive that had grown far more expensive than the state intended. And these changes received widespread support. There were only 3 dissenting votes on the bill in the legislature. So now I'm going to talk a little bit about Rhode Island. And the reason I like to talk about Rhode Island is it sort of gives you an example of how in oh yeah, go ahead.
Just quickly, say the bill. So one piece of legislation renewed, expired, and all the other things?
Yeah, so the way it started out is they had separate bills for each incentive, and that received hearings, and then they just folded them into an omnibus bill. So it was there's nothing inherently right or wrong about that approach, but that's how they did it in Oregon. Yeah, good question. So Rhode Island gives you an example of sort of how in legislation a state can bring a lot of these steps together. And there in your handouts there's a longer description of Rhode Island, but I'll take you through it quickly. First, what they did was they created a strategic evaluation schedule. So they said all tax incentives have to be evaluated every 3 years, except for new ones, which will evaluate after 5 years and then 3 years after that. And they assigned the task of evaluation to the Department of Revenue, specifically their Office of Revenue Analysis. And so they're responsible for measuring costs and benefits and also coming to conclusions about the programs. And what we really liked about the Rhode Island legislation is that then they're, in a couple of ways, it's connected to the legislative process. First, the governor in his budget is required to make recommendations about each incentive after it's evaluated, to continue it, to end it, to reform it in some way. And then there were hearings on those recommendations. So those legislative hearings to bring the evaluations into the legislative process. And Rhode Island isn't the only state that passed legislation this year. There are several other ones. Florida, much like Rhode Island, created a schedule for evaluation. Vermont created this new process for setting goals for tax expenditures, including tax incentives. And Washington also sort of focused on metrics and goals for tax incentives. So let me just wrap up by saying that while doing research is an important part of our work, what we're really most excited about is working directly with states to implement, design and implement the policies I've talked about today. So definitely feel free to contact us at any time. We think this is really interesting work, and like Gary, we don't charge anything for it, so we're happy to talk to you at any point.